This is Ask Mr. Wall Street, and today's question is, what's a good trading strategy in a down market? Today seems like analysis by paralysis. Even dry powder is hesitant about when and where to drop a buy ticket. As retail investors, we're dependent on expert opinions, but unfortunately, like ETFs, all buying the same stocks, the experts are all saying the same things. You don't lose until you sell. Well, this isn't exactly what we want to hear, is it? What would have been the right hedge? For me, it is a strategy of selling calls. Simply put, I would write calls on stocks paying dividends. The strategy is like getting paid to wait. For the sophisticated, it's a research project. For the unsophisticated, it's a search for the right advisor. I suggest selling calls and not buying puts, although most would think that is the right move. But buying puts is money out the door with an expiration date that works against you, whereby selling calls on dividend-paying stocks puts money in your pocket twice quarterly, and you still own the stock when the market hopefully corrects upward. Yes, there are nuances in straddles and spreads, but no need to get fancy. Making money during turbulent times is not easy without a good strategy, so it's imperative to write the right calls and to pick huge liquidity stocks and calls. It would be bad to have the correct strategy but the wrong deployment. For instance, selling calls and pocketing dividends and option fees, great income. Worst case scenario, stock gets called away if price appreciates beyond call strike price. Well, okay, you make money off the strike price above your cost of stock plus the option sales fees. The dividend may shift to the called stock, but so what? Cash flow goes your way. As always, I'm not the only one saying this, but stick it in your noggin because this is the kind of market when volatility reigns, it makes sense to have a plan as opposed to being a spectator. This is Ask Mr. Wall Street, and thanks for listening.